The UK's long-term borrowing costs just hit a milestone. The UK's 30-year gilt yield climbed to almost 5.7%, its highest level since 1998, and for the first time in decades, it's risen above the US equivalent. So why is this happening? Well, part of the story is global. Across the developed world, investors are demanding higher returns for holding long-term debt. In Germany, the 30-year Bund is at its highest in 14 years. France's equivalent has climbed above 4.4%, and Japan's long bond is at a multi-decade high. But in the UK, the move is sharper, and there are several reasons for that. First, fiscal worries. Investors are bracing for heavy government borrowing ahead of the autumn budget. Second, inflation. UK's consumer price index accelerated to 3.8% in July, making investors nervous that inflation won't glide back to target smoothly. Third, demand has changed. Remember the LID crisis in 2022? Since then, UK pension funds are less willing to hold very long gilts. And lastly, let's not forget quantitative tightening. By selling bonds back into the market, the Bank of England estimates it's added around 15 to 25 basis points to yields. So what does this mean for the pound? Well, when long yields rise because of fiscal concerns, the pound can weaken. We witnessed it recently with the pound slipping against the euro. But higher long-term yields could also mean fewer expectations for Bank of England rate cuts. This could help the pound hold its ground against the US dollar. The Bank of England will meet again on September the 18th. At its last meeting last month, the Bank of England cut rates to 4% on a close 5-4 vote. With inflation stubbornly sticky and the rise of long-dated yields, the bank is likely to pause. But watch for any changes to the bank's bond-selling programme. A tweak to quantitative tightening could be their way of calming the long end.